My next guest says the current market environment calls for caution, but he's also not shy of making some bold calls, like he did 3 months ago here when he said he'd rather own Verizon than Tesla for the next year, a call that generated a lot of blowback from viewers, even his own colleagues at the time. But so far, that call is paying off, with Verizon nicely outperforming Tesla, which is down 19% since then. Let's welcome back Chris Grisanti, Chief Equity Strategist at MAI Capital Management. Welcome back.
Nice to see you, Kelly.
I'll give you a little tip of the hat, but do you close the trade now? It's only been 3 months. Do you stick with it for the full 12?
No, I think we're taking a victory quarter of a lap.
Okay.
I mean, we're going the full year, and you know, I think things are going to get progressively more difficult for the economy, and Tesla's in a tough place. It's an expensive stock in a tough industry, and it's a tough road to hoe.
I take your point on Tesla, but I'm curious how much upside there could really be for Verizon, or is upside literally just it doesn't fall another 10% and get a lot worse?
You know, you're in a group that's out of favor. Nobody wanted a non-tech stock that wasn't growing in the first half. But if you paint it a different way, here's a stock that's paying a safe 8% dividend. It's selling for 7 times earnings.
Right.
That probably isn't that economically sensitive. If the economy slows, that's probably the kind of stock that portfolio managers like me will gravitate towards. And the 7 times maybe becomes 9 or 10 times, not heroic. And the stock goes up while the rest of the market isn't, and you're earning an 8% dividend. So
and is that basically what you expect overall here? You know, at some point, 2024, is it recession, or is it just you just don't see a lot of market upside from here?
No, I mean, I don't want to get over my skis, but all signs seem to me to be pointing towards a recession. Folks want long rates to peak, including me. But the problem is when long rates peak, it's great for bond investors. It's not so great for stock investors.
Sure.
You know, bond rates don't peak for good reasons. They peak for kind of scary reasons. The economy is slowing, and stocks tend to follow yields downward. You know, back in 2000, the bond rates peaked in February, and then the stocks peaked 7 weeks later. In 2007, the same thing happened. So I expect both peaks to be coming in the relatively near future, and that scares me. And I'm not calling for Armageddon, but I am cautious.
Yeah, and so you're deploying some of those kind of tactical moves. We talked last year when the home builders were trading also at around 4 times earnings,
Sure.
Very, very low. They're obviously not there anymore, and you kind of gotten out of that one. But there's another one that is in that range now. And my guess is, given what you've cited, you want nothing to do with it. But General Motors is trading at 4 times. And is that cheap enough now that it's priced in all of the potential macro and industry headwinds that could be coming?
Well, you know, it's funny. General Motors is a pretty interesting stock. And value managers like me, we tend to look for stuff that may have some difficulty getting through, but it's just so darn cheap that you need to go there. Having said that, it's really tough to buy General Motors really at any price if you think, like I do, that things are going to slow down before they speed up, especially in the middle of an auto strike. But you know, General Motors, there's a bunch of retailers like Target and others that are also getting really, really cheap.
Yeah.
But again, I think caution, you know, discretion is the better part of valor here, at least for now.
So tell me a little bit, you know, a lot of people are starting to look back. We've seen the utilities snap back from their recent lows, consumer staples, you know, defensive parts of the market that have not performed well so far. Would you stick your toes into those parts of the market?
Yeah, well, the devil's in the details there, Kelly. Like the idea of defensives, but the problem is stuff like, I don't know, staples like Procter & Gamble, there's hardly any growth, yet the multiples are quite high. It's not like Verizon where there's hardly any growth, but you're not paying up for it.
Absolutely.
I like stocks like Verizon where those earnings weren't great yesterday, they were okay. But the stock can go up because the worst didn't happen. Look at Google. Google's earnings were pretty darn good, just missing a little on the cloud, and the stock's down 9%. I like the other side of that.